Bismillahirrahmanirrahim. Let's look at learning objective number 2. That is, you want to analyze the relevant cost, whether you want to decide accepting or rejecting a special order at a special price. Okay, accept an order at a special price. This one, obtain additional business by making a major price concession to a specific customer. So assume that sales of products in other markets are not affected by the special order. So we assume that if you accept this particular order, then that will not affect the other markets. And then assumes that company is not operating at full capacity. Why? Because if you have the full capacity, then you will have opportunity cost. If the first one, if let's say you are not operating at full capacity, that means you have idle capacity. You can fulfill the demand of this special order. So take for example, Sunbelt company produces 100,000 smoothie blenders per month. Okay, you currently produce 100,000, and that 100,000 represent 80% of the plant capacity. That means you can work up to 100%. So currently you are only operating at 80%. So you have another 20% that is idle capacity. Idle capacity means you can fulfill the demand of the remaining 20%. And then variable manufacturing costs are 8 ringgit per unit, and then fixed manufacturing costs are 400,000 ringgit or 4 ringgit per unit. And then the blenders are normally sold directly to retailers at 20 ringgit each. So currently you are selling at 20 ringgit each. And then now you receive an offer. You receive an offer from Kensington Company to purchase an additional 2,000 blenders at 11 ringgit per unit. Currently, you sell at 20 ringgit each. Now you have a new offer at 11 ringgit per unit. So acceptance of the offer would not affect the normal sales of the product. The normal sales means the 100,000 that you currently sell now. And the additional units can be manufactured without increasing the plant capacity. So what should you do? To summarize the question, so you currently producing 100,000 units of blenders. These 100,000 units represent 80% capacity. So if you are producing at 100% capacity, how much is it? So that will be 125,000 units. That will be 100,000 divided by your 80%. So you will get 125,000. That means you are able to produce up to 125,000 units. But currently, you only produce 100,000 units. That means you have idle capacity, you have extra capacity, or you have extra potential. That means you are able to produce. If let's say there were to be any demand, you can fulfill up to 25,000 more. Okay, you can fulfill up to 25,000 more because currently you have this 25,000 idle capacity. That means that you have 20% extra. That means if you receive an order, you don't need to employ a new worker, you don't need to hire, you don't need to, let's say, rent a new factory or because you have enough capacity. That is the meaning of that. All right. So what's about the price? The selling price currently is 20 ringgit per unit, and the variable cost is 8 ringgit per unit, and this one is your fixed cost. And then now you receive a new order. You receive a new order from a foreign wholesaler, and they are offering a price of 11 ringgit per unit. So you are selling now at 20 ringgit. Now you receive an order at 11 ringgit per unit. And they requested for 2,000 units. Can you fulfill the demand? Yes, you can fulfill the 2,000 units because you have idle of 25,000. Okay, you have idle of 25,000 units. So there is a demand of another 2,000, but they want to purchase at a lower price, at a selling price of 11 ringgit. So question, should you accept or should you reject the special order? So in order for you to make that decision, you have to consider your relevant cost. Okay, now you have to do the incremental analysis. If look at the option that you have, if you reject the order and if you accept the order, what happens to your net income? So what about the revenue? If you reject the order, that means you don't take take up the order, then you won't get any revenue. So you will get 0 revenue for that. But if you accept the order, then you will get the selling price per unit is, how much is that just now? Selling price is 11 ringgit per unit. 11 ringgit per unit times 2,000. Okay, times 2,000. So you will get 22,000. So there will be a net increase in your revenue of 22,000. What about the cost? If you reject the order, of course, you don't have to incur any cost. So your cost will be 0. But if you accept the order, you will incur a variable cost of 8 ringgit per unit, and you receive an order of 2,000 just now. So 2,000 times 8 ringgit will give you 16,000 ringgit. So 16,000 is your cost. So that will be a negative figure here. So we are talking about the cost. And then what about the net income? Again, if you reject the order, you don't get any net income. But if you accept the order, your revenue is 22 and your cost is 16. So 22 minus 16 gives you 6,000. So that will be a net increase in your net income. So the net income will increase by 6,000 ringgit. So what about the fixed cost? The fixed costs do not change because you still have the existing capacity or spare capacity. And in that case, the fixed cost is irrelevant cost. So it is not relevant. So you do need to consider your fixed cost in making this particular decision. Whether you reject the order or whether you accept the order, you still have to incur that particular fixed cost. So in that case, fixed cost is irrelevant. And then what about the variable cost? The variable cost changes. You can see if you don't accept or you reject the order, the variable cost will be 0. But if you accept the order, your variable cost will be 16,000. So variable manufacturing costs are the relevant cost. The same goes with your revenue. So in that case, should you accept or reject the special order? So the answer is that you should accept the order. You should accept the special order because the net income will increase by 6,000 ringgit. Right? So based on the calculation, based on the incremental analysis, it helps you to make decision. And when you want to make decision, only consider the relevant cost. The fixed cost remain unchanged. So the fixed cost is irrelevant for your decision making. And then consider about the capacity. Because you have idle capacity of 20%, then you can fulfill the demand without need to incur any further cost. So in that case, you accept the order and then say something about the revenue or the net income that say something about the net income that you will get by accepting that order. So hopefully you get a better understanding on this. So this one is the second decision that you need to make. Okay, with that, I thank you.